So welcome back for part two, guys. So we've been over what is liquidity and we've been over how to spot it in the market. So today's video is going to be on liquidity sweeps, which is essentially, so you've got your sell side liquidity, as we know, and it's essentially the moment where price takes it out. So prime example here, sell side liquidity got put in, we traded all the way up here, came down, and we have just taken it out. So this is known as liquidity sweep. And look what we're doing now, we're reversing. So like I've said many times already, once banks take out one side liquidity, they like to reverse it and send it the other way to take out the opposing side liquidity. So we've just taken out sell side liquidity, so what can we expect now? We can expect some buy side liquidity up here to get taken out. Let me mark these out. I can't type. Okay, we'll call it buy side lick. And we will save that. And we'll call this sell side. So yeah, we've just taken out sell side liquidity, so what can we expect now? Buy side liquidity to get taken. We have tons up here. This is a 7-minute time frame, so it's a pretty low time frame to be honest, but as I loaded up the chart, this is what it was on, and it gave a prime example, so I thought I'd show it quickly. So we have all this buy side yet to get taken. And we've just taken out sell side liquidity, so we could expect price to reach up to some of these buy side liquidities. But yeah, so that's essentially what liquidity sweep is. So we have, let me go on my higher time frames like the last video. Let me take this back. So let's just look at this chart here for a sec. I'll give you a minute to mark out your buy side and your sell side liquidity in your head. Just mark them out, the prominent highs and lows, the swing highs and the swing lows in the market. Where are they? So where is your liquidity? Give you a minute. Okay, cool. Obviously, you don't have to know all of them. So, main one that points out to me is up here, which is obviously buy side. Next one are these equal highs, buy side. I will talk about equal highs and equal lows in a minute too. That's a good point actually. Another one here. We have more highs here, but I don't want to mark out all of them because it would just get look too clustered. And then the main sell side that sticks out to me is literally this low here. So from this chart here, where do you think price is going? Is it going towards buy side liquidity or is it going towards sell side liquidity? Which one is it most likely to take out from where price is right now? We're right here, we're here right now. Where are we likely to take out? Sell side. Just look how close we are. And this is a huge swing low in the market. So there's no liquidity sweep yet because we haven't taken anything out. We haven't taken out this low here. I'm going to mark that out as well actually. So we have two of each. So we are yet to take anything out. So there's no liquidity sweeps yet. Let's play this. Oh, look at that. We've just taken out that low, so we've taken out liquidity. And we've now taken out our major target. So this is a liquidity sweep because we have taken out the low. And this is where price is at right now, so it hasn't had time to reverse. Now I'll give you an example of where price has reversed. Okay, let's do the same thing. I'll give you a minute to mark out your key areas, your buy side and your sell side. Focus on the sell side on this one though, because it's very obvious. Right, cool. Sure you have a mental image of where it's at. So this one just got taken out, so I'm going to ignore this one. Sell side. Sell side. Cool. Cool. Then we have buy side up here. We of course have lots of buy side up here as well, but I'll just keep the chart clean. So now let's wait and see what price happens. So there's no liquidity sweeps yet. And then what's that? Price has taken out this first lot of sell side liquidity, and it takes out the next one. So it's taken these lows out. It's taken out the sell stops in the market. And now what can we anticipate? We can anticipate price to go higher, which look, it does. Because the market movers have managed to fill their orders, because they've taken out sell stops, so they can fill their buy orders and send price up into what? Where are they sending price? To buy side liquidity. Look, took it out. Next one's up here. See if that gets taken, and it does. So price will take out one side of the market, the sellers, and we come up, and now what have we done here? We've taken out buy stops. So this happens every single day, guys, on every single time frame. Now price took out buy side, so what's it coming down for? More sell side. Took out sell side, what's it coming back for now? The new high, which is now buy side. And it took it out, look. So this just happens every single day. So yeah, when price gets taken out, that is called a liquidity sweep. Let me get rid of. So example here, where the high buy side liquidity gets taken out. Let me actually play this one back because it's a great example. So we have our buy side and we have our sell side. Cool. This is our little range to play in. Wait for one's other side of the range to get taken. So we took buy side liquidity, and now we can anticipate price to come and take out sell side liquidity. And that's exactly what happens. So that's how you can play in these little ranges. You mark out the range high, you mark out the range low, wait for one to get taken, you can anticipate price to move in the other direction and take the other side out. So that's essentially liquidity sweeps for you guys. It's when, so we've got our buy side and sell side liquidity marked out, and you're waiting for them to basically get pushed through, and that is a liquidity sweep. So has it been a liquidity sweep on this high yet? I'll let you guys work that one out. Correct answer is no, because look, price hasn't come up here. If price shoots right here and goes past it, then yeah, that would be a liquidity sweep, but price has not done that, so there's been no liquidity sweep yet. Is there a liquidity sweep down here? This low here? Sell side? Has there been a liquidity sweep? Let you guys figure that one out. No. Why? Because we haven't taken it out yet. If price comes and pushes past this low, then yeah, that'd be a liquidity sweep. So we have this low here. Has there been a liquidity sweep yet? Let you guys answer. This low here, guys. Yes, there has. Because why? Because look, price has pushed down past it. So that's officially a liquidity sweep. So that's liquidity sweeps, guys. It's really basic. It's just once the liquidity gets taken out, once price pushes past it, that's a liquidity sweep. Then we can anticipate reversal. But not always so I've been talking about how, say, a high gets taken out, and then we can anticipate the low to then get taken out after that. That doesn't always happen. It sometimes just continues and pushes straight past the liquidity. So let me give you an example of this happening. Right, here we go. So let's focus on this area of price action. Focus on this area. So we've got our buy side liquidity, of course, and we have our sell side liquidity. Of course, we have more highs and lows, but I'm just keeping it simple and using these to keep the chart clean. So let's see what happens. Okay, cool. So we've just had the liquidity sweep. We've taken out sell side liquidity. So what can we anticipate now? Price to move higher and come and target buy side liquidity, because that's what we want to happen. But let's see what happens. Notice how we keep pushing down past this low. Let me extend it out. Notice how we carried on pushing down this low and we didn't come up and take out any buy side liquidity. You notice how we just carried on pushing down. And you might be thinking, why? I thought liquidity sweep's going to make it reverse. Not always. And why? So it's continuing to push down this low, most likely because, look, what do we have here? We have more sell side liquidity down here to get taken yet. So this low must be more prominent than this low, because this low hasn't had a reaction off of it. So price might just be coming and drawing towards down to this low. So you've always got to zoom out and see the bigger picture. Just because price has taken out one low does not mean it's going to reverse and take out the opposite side high. Because first it might need to take out a further low down. Do you see what I mean? And it's the same with buy side liquidity, just the opposite way around. So just because we've taken out one low, which is sell side liquidity, does not mean we're going to reverse and take out buy side liquidity just yet. Because the main target might be lower. It might be this low, or it might not even be that low. It might be these lows. Let's see what it does. So we've taken out the low, and then yeah, look. So this must have been the target, this low. Because we've taken it out, and now we're reversing. Now we're reversing to take out buy side. We did not get a reaction off this low, did we? Because we carried on pushing down. Instead, we're getting a reaction off of this low, this sell side liquidity here. And we've just come and taken buy side liquidity. So this was the low that we should have been interested in and not this low. And how can you determine which low or which high is going to be used and reversed against? Well, simply the higher time frames hold higher power, meaning a low on the weekly time frame holds a lot more power than a low on the daily time frame, any of these lows. And I'll explain to you why. Because if we go, so we're looking at a weekly time frame right now. This is all weekly liquidity. However, let me come out of bar replay. However, we have access to 1 minute time frames, meaning each candle takes a minute to form. And let me just show you how much liquidity is going to be on the 1 minute time frame. It's going to be everywhere. Literally everywhere we look, there's highs and lows. But look, you might be thinking this is sell side liquidity, which it is. Of course it is on the 1 minute time frame. Then if we go on the hourly time frame, look. Hang on, let me go on the 4 hour. On the 4 hour, there's no low here. Look, that low is here. But is there a low here on the 4 hour time frame? No. Because the 4 hour hasn't formed yet. However, on the 1 minute, you've got both of these lows. You've got a low here on the 4 hour time frame. You haven't got that. Where is it? You haven't got that low. On the 1 minute, you have lows here. So you have to be careful because the higher time frames always hold higher power. So the highs and lows on the higher the time frame, the highs are, the more prominent and the more confidence they're going to give you to be working, and not all of these 1 minute highs, because there's going to be hundreds and hundreds of 1 minute highs being printed all the time. However, on the hourly, on the 4 hour, on the daily, the weekly, you're only going to get on the daily time frame. Look, let me just show this to you. Every single day. So these candles represent one day, an entire day they represent. And look, each day you're getting one high and you're getting one low. Yeah? This is 1 day's worth of price action. One day you're getting one high and you're getting one low. The next day you're getting one high and you're getting one low. So every day you're getting one high, you're getting one low. However, if we go onto the, let's say, 5 minute time frame, and let's find the start of the day. So the start of the day is here, here to here. Look how many highs and lows we've got. They're everywhere. Here, 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 down here. We had a high, low here, but that got taken out by this wick here. See, they're everywhere, guys. However, on the daily time frame, there's only two. There's only two. Whereas on the 5 minute, there's 1, 2, 3, 4, 5. And that's not even listing all of them. Then the 1 minute time frame, there's gonna be tens and tens and tens of them. Look at all of them. Highs everywhere, lows everywhere. So the higher time frames are always going to have less highs and lows, but they hold more power. There's going to be more liquidity behind and above them. There's going to be more liquidity on the daily time frame above each high and above each low than there is on the 1 minute, because these 1 minute candles are getting printed every 60 seconds, meaning there's not enough time to gather enough liquidity above each high and gather enough liquidity above each low for it to be extremely high confluence. However, on the daily time frame, each high has had a day's worth of liquidity to gather above it, and a day's worth of liquidity to gather above the low. However, on the 1 minute, you're only getting 60 seconds. So which liquidity sweep would you rather take? One on the 1 minute time frame or one on the daily time frame? Of course, a daily liquidity sweep, like we've just had. These lows have just got taken out. There's going to be more liquidity below these lows than there are on these 1 minute lows down here. There's going to be tons more liquidity on the higher time frames because they've had a longer time period to gather more sell stops, more buy stops. Because guys, you've got to think, so buy stops and sell stops are of course your stop losses. So imagine how many stop losses people are gonna, let's go on the 4 hour time frame. Imagine how many stop losses right now are below this low here. There's gonna be tons and tons and tons and tons of stop losses, sell stops underneath here on the 4 hour time frame. However, on the 1 minute time frame, so that's had 4 hours to gather all of those sell stops. However, on the 1 minute time frame, let's mark out this low here because there will be people long here with their stop losses underneath here. There's only had, let's just count, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 minutes. Only 10 minutes worth of stop losses are under these lows. 10 minutes. Whereas on the 4 hour time frame, you've had 8 hours. 8 hours. You've had 8 hours worth of stop losses under these lows because there's 2 candles since that low got put in. So where is there going to be more liquidity under the low that's had 8 hours to gather stop losses, or 8 minutes? Of course, the 8 hours. Did I say 8 minutes or 10 minutes? Same thing. 10 minutes worth of stop losses or 8 hours worth of stop losses. Of course, that's going to be more on the 4 hour time frame where it's had 8 hours for people to put their stop losses underneath. And on the 1 minute, they've only had 10 minutes to put their stop losses underneath. So there's going to be a lot more on the 4 hour time frame than there is on the 1 minute time frame. So what does that tell us? It tells us that there's so many liquidity sweeps on the 1 minute time frame that they're not all going to be valid because there's going to be so many of them. Whereas on the 4 hour, you might only get one a day, but that's a much more higher confluence than all of the tens and tens of 1 minute liquidity sweeps. So what you need to do now is go onto the chart yourself and literally just go around finding liquidity sweeps. Whether or not it reversed or not, just mark it out. Liquidity sweep. Liquidity sweep. Liquidity sweep. Just go and mark out highs and lows and where they got taken out. Yeah, so don't get caught up in all these smaller time frames because, like I just said, if you're basing your stop loss off these lows here, there's only had 10 minutes of price action in between, so there's not going to be much liquidity down here for banks to target. Whereas if you enter on a 4 hour time frame, or not enter, I'm talking about just liquidity here. So if you're looking for liquidity on a 4 hour time frame, it's going to be much better because it's had 8 hours here. In this specific example, it's had 8 hours worth of price action to gather all of those stop losses, meaning the higher time frame liquidity sweeps are much better to take than the 1 minute liquidity sweeps, because there's so many liquidity sweeps on the 1 minute time frame every single day. Whereas on the 4 hour, there might only be one or two. And we do use all of these time frames to form my entries, but the basis of our entries are always liquidity sweeps, and we want to be taking high time frame liquidity sweeps because they're much higher confluence than the lower time frames, because there's less of them, meaning there's more liquidity in every single one. Because there's less of them, so it's had more time to gather, buy and sell stops. Whereas on my 1 minute time frame, it has not had enough time to gather enough sell stops and buy stops for banks to care about. They care about these high time frames where there's tons and tons of resting sell and buy stops.